Federal Reserve's policy, many believe, will eventually lead to a dollar collapse. And some actually think that the Fed's policies will intentionally lead to such a collapse. Now, I don't happen to believe that, and I'm going to show you why. Now, they say that the Fed has a dual mandate given to it by Congress, which is to maximize employment, stabilize prices, and moderate long-term interest rates. That's actually three, but that's what they call the dual mandate. My contention is, however, that the Fed's job is to manage two of the most important assets that the United States has: the dollar and treasury bond demand. Without the dollar, without the ability to issue U.S. treasuries to foreigners, the U.S. cannot fund its welfare warfare state. So it must absolutely have confidence in the dollar and demand for U.S. treasuries. So I think that whatever the Fed does, its primary concern is to make sure that those two most important assets are there, that the dollar remains not too strong, but also not too weak. If it's too weak, confidence is lost. If it's too strong, it becomes too expensive to sell military hardware overseas. So the Fed is focused on keeping the dollar within a range that's acceptable and also retaining confidence in the dollar such that people buy, not people, but foreign banks especially, and investors view the U.S. Treasury security as a liquid and valuable asset to hold. So I'm going to show you how the Fed has managed this process over the last 10 years, and then we're going to go back and look all the way back to 1971. But here's one thing's for sure. When the Fed engaged in QE, had they said initially, here's what we're going to do, starting in 2000, the end of 2008, when the first QE started, had they said, for the next 5 or 6 years, we're going to print $4.5 trillion. We're going to buy worthless mortgage-backed securities, and we're going to buy 90% of the newly issued U.S. treasuries, the dollar would have absolutely collapsed. But yet, that's exactly what they did. And look where the dollar is now. The dollar is higher today now than it was when the Fed started that reckless policy. Now, why is that? Well, that's because they never announced such an intention. What they did was they started QE1, and then they did QE2, and then they talked about not doing any more. Then they did QE3, and then they said we're going to taper it, and then when we end QE3, we're going to raise rates. And that back and forth created a mentality that somehow the Fed wasn't engaged in a reckless policy, because they were always talking about stopping the current QE program that they were on, tapering it, and eventually raising rates. But as you see, from 2008 to 2015, they did nothing but print money and keep rates at zero. They did a lot of talking in between, and that's the important part. The talking is what kept the dollar strong, open mouth operations as they're called, because the Fed did not engage in anything resembling a sensible policy, but they gave all indications that they would. So if you look at the charts, you see the dollar had been falling all through the early 2000s because there was a lot of focus on the U.S. deficit. It was ballooning, and there didn't seem to be any end in sight. The financial crisis hit, and the knee-jerk reaction was, oh, buy the dollar. Okay, so you see the dollar shoots up, and then the Fed realizes it has a problem on its hand. It decides the way to get out of it is to do QE. They do QE for a while, and then as you see, around 310, by the time QE, the first QE is about over, the dollar has fallen. People are concerned. Foreign central banks are concerned that the United States is self-dealing and printing money and buying their own securities. The dollar falls. So what does the Fed do? They stop doing QE. And as they stop, the dollar starts to drive back up. Once it moves up again to where they have it at an acceptable level, they start QE2. Same thing happens. The dollar falls back down. By the middle of June 2011, people are concerned that this thing is never going to end. They've done two QEs, and as you can see, that's when the Fed decides to throw in the towel and end the QEs is when the dollar falls. Then dollar starts to move back up, gets up to a point where the Fed feels comfortable. They can launch QE3. They do that, but this time they were smart. During the entire time of QE, after 6 months of launching it, they start talking about tapering QE. And while they're talking about tapering QE, they're talking about raising rates. What does that do? It keeps the dollar in a range because it doesn't look like it's now QE infinity, because the Fed is talking again about stopping this program and eventually raising rates. Now, as soon as the Fed ends QE, no surprise, Japan starts QE. Well, that sets the dollar off back up. The dollar index starts to head back. ECB decides they're going to do QE. Now remember, the United States and all the central banks, there are no currency wars as such. They coordinate their central policies. They're all fiat currencies. They're all on the same boat. They realize that it is now Japan's turn to do QE. It's ECB's turn to do QE. They hadn't done it yet. So the Fed, through Stanley Fischer, spoke to Mario Draghi and said, you got to do QE because it works so wonderfully in the US. Now, QE is a standard feature. It's not an emergency policy. The major central banks of the world do it. So if the Fed wants to do it again, look where we are. We're way up here. Why? Because the US pays interest. The dollar is strong. ECB's doing QE. They've got negative interest rates. Japan's got negative interest rates. Now, it looked like the Fed was in the driver's seat. They managed to do a rate hike in December, and that kept the dollar up pretty high. Then it looked like this year, in 2016, it started to fall. Why? Because the Fed started making noises about maybe we won't do 4 rate hikes in 2016. We may not do this gradual rate hike path because, well, the economy's not as good as we thought it was, so maybe we'll do 2 this year. And then look what happened. At the beginning of May this year, just a month ago, what started was another open mouth operation, what I call the Fed yak attack, because the dollar had fallen precipitously. If you look from early 2016, right after the rate hike, and all the talk leading up to the rate hike, it pushed the dollar up to dollar index almost up to 100. It had fallen down to about 92. That's when you saw all the Federal Reserve presidents come out 1, 2, and 3 times each during the month of May saying rate hikes are on the table. June is a live meeting. That shocked the markets because they had considered that the economy wasn't strong and that the Fed was going to hold off on raising interest rates. Well, if that perception had persisted, the dollar index would start to fall down here, and you'd start to see dumping of treasury bonds. You'd start seeing a decline in demand for treasury bonds. So instead, we had the Fed yak attack starting in May, and everything was working very well. They drove it right back up to 96. Markets were convinced that a rate hike was coming in June, possibly July. And then last Friday, we had the non-farm payroll. Came out at 39,000 new jobs. Not a sign of a solid, strengthening labor market. So people started to think there's no way the Fed is going to raise rates when the labor market, which is one of the Fed's considerations for when they would raise rates if they see further strengthening in the labor market, well, it didn't look like that strengthening was happening. So the dollar index, you can't see in this chart, started to fall back. But even earlier this week, we had Fed Chair Janet Yellen out, still not throwing in the towel. Why? She cannot say the Fed is not going to raise rates because that would drive the dollar back down further, and she's not going to do that. Instead, what she said was, if we see further strengthening in the labor market, it may be appropriate to raise rates. She's still talking in the past tense. We're going to see further strengthening when we just saw further weakening. And the reason she's doing this is to put the brave face on the economy, which puts a brave face on the Fed, which shows that the Fed is going to raise rates. Now, if the Fed's only concern was full employment and they thought that keeping rates low would create a better job market, they would call off rate hikes. The reason they're not calling off rate hikes is that's not really their main concern. Their main concern is maintaining this dollar strength, which they need to have. They need to keep it in a range. They cannot have the dollar fall. They cannot have the dollar collapse. So if the dollar ever collapses, it won't be because the Fed does a self-inflicted wound. It'll be because confidence is lost in the way the Fed manages policy, and or another central bank somehow manages their monetary policy better, i.e., backing their currency with gold or just having a. But right now, there is no better game in town than the Fed. Unfortunately, that's the way it is. So the Fed isn't stupid. They may talk about data and all types of things to confuse people, and that is confusing because if you look at the data, the incoming data would tell them, no, you don't raise rates. But they're still talking about raising rates because they cannot allow the dollar to fall past this point. Now, I want to go back to, if you look where the dollar used to be, it was much, much higher. The dollar index was up to 165 in the mid 1980s. But this whole dollar has been on a fiat standard since 1971 when Nixon took the United States off the gold standard. And that immediately caused inflation and drove the dollar down, notwithstanding the petrodollar agreements in the mid 1970s. And the dollar had lost confidence. Even though it was the world reserve currency, it was only the world's reserve currency because it was backed by gold. And when it was no longer backed by gold, the need to have dollars other than to buy oil and foreign reserves became a less attractive opportunity. So what happened at the late 1979, 1980, the Fed pushed interest rates up to 20. As you see, that set off, it broke the back of inflation, and it also caused the dollar to rise. And we had a kind of an economic recovery from 1982, 1983, all the way through 87 when the stock market crashed. And then the dollar, remained relatively low. It's lower than it is today. But during the 90s, when you had the internet boom and the supposed balanced budget, the dollar got stronger again. Then, after 9/11 and Greenspan bringing rates down to zero, increase in deficit spending, deficits ballooned, there was a lot of public attention on deficits. The dollar collapsed all the way until the financial crisis of 2008. Ironically, the financial crisis of 2008 caused the dollar to go back up, and then we've just covered what happened since 2008. So in closing, I just want to say that the way I look at Fed moves are not whether the employment numbers are good or the stock market's gone down or whether they're trying to protect the too big to fail banks. All those can be considerations if they match the objective of keeping U.S. Treasury bond demand strong and the dollar within an acceptable range where they have confidence that the dollar is strong, not too strong, but also not too weak. Thanks for listening.